right, good afternoon, everyone. Today we're going to talk about the One Big Beautiful Bill Act, OBBBA, as it has come to be known. This was signed this past July 4th, 2025, and it presents some major changes in federal tax law, and I wanted to go over some of that. The big takeaway, I think, is that we're going to see a lot of permanent law coming from this on some of the tax provisions, and that's going to be well deserved, well looked after, and wanted for our purposes. It helps with planning quite a bit. We aren't going to be talking about the Washington State changes that came out also this summer. Those ones we've discussed in previous webinars, and if you haven't yet seen those, I would encourage you to get the links for those and see those ones when they come along. Coming up on this, though, is the big takeaway from the Washington law is we had a $3 million exemption at the state level for state taxes with a top rate now of 35%. And indexing turned back on. And then on capital gains, they did add an additional surtax that brings it up to nearly 10% for certain sales. And so if you're in Washington State and you are concerned about either of those issues, those would be good webinars to catch also. So this is not going to be a down and dirty, gritty, in the weeds type of presentation here. This will be more of a practical, how does this relate to you? And we will go ahead and just provide some ideas about how it might impact you. This might not be for you specifically. It might be for a family member, maybe a parent, maybe a sibling, maybe a child or grandchild, where some of this might work. So just going to give you a real heads up view or top line view on it here. So first of all, what are we going to be looking at? We're going to be looking at the federal tax changes. It's called the One Big Beautiful Bill Act. We really consider this an estate tax victory, and we'll talk about that. There are some income tax relief provisions and deductions and business tax planning provisions in there that might apply to you. Some tax planning opportunities, I think, also, and a few takeaways. So that's our agenda for the day. If we first go ahead and look at those, the federal highlights, the big news here is that this is really an extension of many of the provisions that were in the 2017 Tax Cuts and Job Act, the TCJA, as it was known. Those changes were going to expire at the end of this year and would have caused a significant difficulty with many folks on their tax provisions, which would generally have gone up quite a bit. So we're going to see some of that. There's also some targeted relief for some specific situations in here and a few other provisions that will be helpful. Okay, so the key takeaways on this, the first here is that we are going to see those rates and brackets that were in the TCJA made permanent. We're going to go ahead and have the top rate stay at 37%. We're going to see a standard deduction increase. And then there's also this new senior deduction that's coming in. And we're also seeing an increase on the SALT deductions, which may be useful here in Washington. And then no tax on overtime, tips, increased child tax credit, a few of these types of things, which we're going to go ahead and look at also. I think probably the opportunity here is if you're in the right tax brackets and it works for you, that SALT deduction could be a big adjustment for you and would be something to look at. This law overall is massive. It's 870 pages long. There's a lot in here. So this is, again, just a high level look at it. So do talk to your other advisors who's helping you with income tax issues or financial planning for more information. I just went over this with you. So for our purposes, what we're really excited about here in the new act is going to be the $15 million federal exemption as of the 1st of January. It is made permanent. We do have indexing on that, and that's going to be very helpful because we can combine that and use that for planning here in Washington State, where we do not have a gift tax exemption. So that federal exemption will help us to reduce Washington State estate taxes. So here is the big numbers that matter on the OBBA. First of all, we just spoke about the estate tax exemption increase to $15 million, and there's these new worker deductions. Those are going to be with us for about 4 years, and then we have our SALT cap relief for another 5 years. That was the one that there was a lot of back and forth in Congress about, was the SALT deductions, and that stands for state and local tax. And really what happens there is it permits you to take deductions for taxes paid to the state. All right, and as we're looking at the capital gains issue here we really have a couple different perspectives on this. The first part of this is really that there is this qualified small business stock. So this is kind of an interesting opportunity for founders and early employees, and investors. If you happen to be in that category, you're going to need to study this quite a bit and look at it and see if, in fact, you have an opportunity here. What it allows you to do, if you do qualify for that qualified small business stock, is to get protection from capital gains tax on the sale of that. So when those oftentimes it's for business that might be getting ready to be sold, and you're looking at this, and it's an opportunity to get out of that. The exemption is going to go, the exclusion, is going to go from $10 to $15 million, and so that's a big increase on that. We compare that to other types of investments and other types of capital gain protection you might have, and I just remind you that on gifts you get a carryover basis, but if the assets are inherited at death, they're still going to receive that step up in basis. So again, we're just looking at ways to address the capital gains tax here. All right, so let's look at that estate tax victory and why that's important for us. So as we see here, before this law went through, the OBBBA, I keep getting that a little bit wrong, we were going to be looking at really the federal exemption being cut back to $7 million and instead we've ended up getting this we're getting this extension here, and so it's $15 million per person starting next year. A couple can go up to $30 million. We do have the ability to have portability still remaining. So this is a unique feature for federal estate tax law, where if you do not use your exemption at your death and you are married, you will be able to provide that to a spouse. That's not universal. If your spouse is not a U.S. citizen, that may not be available. So you do want to look at whether or not that would make sense for you, or if you have to plan around that. But that's generally the rule. To kind of show the difference there, we can go ahead and look at the generation skipping tax exemption. This is another federal tax. These are all transfer taxes at the federal level. So you have a gift tax and an estate tax, which are using the same exemption. It's called a unified exemption. Then we have our generation skipping tax exemption, which is another tax on top of it. Both of these taxes are 40%. So, for example, if you were making a gift of $1 million to a grandchild, you would have to pay 40% federal estate tax on that and 40% generation skipping tax on that transfer, unless it was qualifying for an exemption or exclusion or something else here. And the difference here is that when we're talking about GST, just to remind you, we do not have portability between spouses. So it's more of a use it or lose it. This is more similar to the Washington estate tax exemption, which is also a use it or lose it. And so there again is some unique planning we look at here. If we are thinking about moving assets to grandchildren, it makes a lot of sense to make those transfers during life to avoid the Washington estate tax, to avoid federal estate tax to the extent you have an exemption, and also the generation skipping tax exemption. So that's part of the planning you're looking at on that. Again, I did mention that under the prior law, we were expecting it to go down, that federal exemption. So currently, we have a $13.99 million exemption. We are scheduled to go down to about $7 million beginning of the year. And so for some clients and folks out there, we're really looking at that as a cliff and wanting to do additional planning here before the end of the year to move additional assets out of their estate, take advantage of those large exemptions. So for now, at least, that is not going to be our issue. We're going to be able to get that $15 million exemption. It's, of course, said it's permanent here. It's permanent until the next president and Congress decide to change it, which happens quite often. But here we see, at least for the foreseeable future, we do have a $15 million exemption. I think it's not illusory. It's not like, the next, if you had a Democrat come in, for example, or the Senate and the House were changed over, that you would automatically see this being cut. I note that really since everything since really 1997, all of the estate tax law changes that have happened have been taxpayer favorable, and it hasn't really mattered which administration has been in power. I also note that because it is said it's permanent here, this is how they're scoring it from a tax perspective, is that this is, will be tax neutral from here on out, that it's, that's kind of the baseline now, is that's a permanent number. And so if they were to reduce the exemption, that would be seen as a tax cut, or a tax hike. And so it just puts it in a different category when they're having their debates and their discussions. So it's not completely safe, of course, but it is, I think, more safe than it had been by quite a bit. And at least we don't have, the scheduled drop off, say at 10 years from now. On the other side of the argument, we can look at how much the deficit is and where the spending is and some of the needs that the federal government is facing. And we could imagine that this might be a place where the federal government will try to increase taxes, much like the state of Washington did, where they increased the exemption, but they also increased the max rate. So anyway, just keep watch of that. Other states, the same thing. Even if you're in a state right now that doesn't have an estate tax, California is a good example that doesn't have an estate tax. Doesn't mean it will always be that way. If California decides to meet their budget shortfalls that they need to add an estate tax, they very well could. Okay, so enough of the estate tax planning. Let's go ahead and look at some income tax provisions that we have in the bill. Now, as a general rule, we do our income tax planning here in our office as it relates to estate planning. So capital gains, charitable planning, retirement accounts, these types of things are typically what we're looking at. There is also some analysis we will do looking at income tax rates of beneficiaries versus the parent, for example, or the tax rates of a trust. And so there is some of that we can do when we do our tax planning. But we're going to look a little deeper here, and we're going to look at some of the more general provisions. And again, these would be ones that I would urge you to speak to your other advisors about. But it is something good to know about, and if it is relating to you, then yes, of course, go ahead and consider using it. So the first one is the much discussed tips deduction. How does that actually work? Well, first of all, we're going to see that it must be an IRS listed type of tipping occupation. So, for example, I couldn't change the way I charge and then just request tips and expect to get a deduction on that. So these would be all the typical type of businesses that are employment that you can imagine. And of course, there are phase outs at higher levels. So as we think about that, it's also, we also have another one in here about the overtime deduction. The overtime deduction is another one that's going to have, can be only for time and a half, and there's going to be limitations on how that can be used. Because it is also phased out when we get to higher incomes. And so that would be kind of what you would expect, is that those types of deductions are very targeted. But again, this could be great. Maybe you have, like I do, I have a daughter who will be starting employment this fall, and her profession, she might get overtime, and if she does, then she might be able to get a deduction on a portion of that. So that would be nice for her. And we also have the senior deduction. Now this one is, again, we're looking at a new deduction that's added in here, $6,000 for 65 and older, $12,000 for a married couple. And you can see that we do have the phase outs of those listed at $75,000 and $150,000. So how would you use that deduction if you happen to qualify for it? Well, this might be a great opportunity to do a Roth conversion or charitable giving, or other income shifting to try to get into the spot where you could get those conversions, deductions. The deductions really for income tax planning, it's a marginal benefit. It's going to be maybe a few percentage here or there on your marginal rate, or your effective rate, if you will, for your income taxes. But over time, that can really add up. And so that's when you're thinking about income tax planning, that's really what we're looking at. All right. Did you get that? Oh yeah. So now we're over to our auto loans. This is kind of an interesting one too. So the big thing here must be assembled in the USA. Again, check with your auto dealer when you're buying a car. It has to be a new vehicle. It can't be used. It has to be for personal use, and there needs to be a loan on there, of course, to get the interest deduction. So once you get the deduction, then let me see what the limitations are here. Yes, there we go. $10,000 annual limit, and of course we do have phase outs on this. So again, if you are able to take those personal deductions, this could be an opportunity for you on that. If not you, maybe a family member again. All right. And then let's go ahead and discuss really the big one, I think, which is the state and local tax so-called SALT relief. So this is we have this for 4 years, 5 years, I guess, and it's a temporary increase up to $40,000. So instead of just getting an extension of the SALT provisions that were there, they actually got an increase on this. So, of course, what this means is that you're paying state or local income taxes. So you'd have to be paying those $40,000 of taxes, and be able to itemize those deductions and get this on there. So the $40,000, just depend. You could go ahead and multiply that by whatever your effective rate is. If you happen to be like in a 20% or 25% bracket or 27% bracket, the math would be pretty straightforward on that. So we're going to go a little bit more into some of these business provisions. So the business ones are kind of complicated, but again, if they happen to fit your situation, this would be a great thing to go ahead and look at a little closer. All right, so let's go ahead and take a look first at the qualified business income deduction. The qualified business income deduction, this is really an extension of this. This gives us a lot of clarity when businesses are making and business owners are making key tax decisions with that permanency of this. It's the 20% deduction, and then you also have the 100% bonus depreciation, and we have the research and development expense immediate deduction. So all of these are, aimed at really the 100% bonus depreciation, the R&D expenses, and are really looking to help encourage people to invest in their businesses and to get more of a tax benefit from that. We also have our interest expenses limitations on that. That's coming in with this. So I'm not going to go into a lot of detail on all of this, but you can see there that quite a bit of this is helping for reducing the taxes on small businesses. The small business stock, the qualified small business stock exclusions, is really an interesting provision. So if you've never looked at this, this is a way to maybe move out of a small business. You can do some different types of stacking. We'll look at a little bit here when we get into strategies. So as we're thinking about the strategies, again, I think it's incremental. So if you can save a little bit of tax dollars on a yearly basis, it can make a big difference beyond going forward on that. For workers' relief, excuse me, we already looked at that. 18 is where we're at. Let me get to the correct slide. So maximize those SALT deductions. Go ahead and use them. Try to, if you can, control your income to make it so you can qualify for those SALT deductions. Utilize the bonus depreciation as much as possible, your Section 179, and interest deductions. Go ahead and doing any estate tax planning that you can do here. All right, let's jump on to the next one. Excuse me, not sure why it does that. Maximizing the qualified small business. All right, so this again is kind of an interesting one in the provisions. There's another interesting provision that's out there with the opportunity zones. And so these are provisions which really can be utilized together in ways to help find ways to invest or to start businesses, and maybe get some protection for some of the capital gains tax that might be there. So for certain businesses, if they qualify, and there is a full list of ways to qualify for that, the big part of it is the holding period of 10 years. This would be an opportunity to really to sell these businesses. And you can also stack this by having a trust or a child also receive these benefits or a portion of the stock. And so it's possible to get additional protection on the qualified small business shares when those are eventually sold. Again, I'm not going to go too much into the depths of that one just because it is a fairly unique situation out there, but it is part of what's in the tax code. So let's look at a few key takeaways. A couple of the key takeaways to consider is that really that we have the federal exemptions for state taxes are being increased. We have the it's being made permanent. We also have many of the other provisions in our tax code as it currently sits being made permanent. We are getting an extension of the SALT provisions up to $40,000. We are also getting additional kind of personal tax incentives there with the auto loan, for example, or the tips or the overtime. So there are some provisions there that in certain circumstances may make a bit of difference. And that's kind of the main parts I wanted to do in this presentation. Again, I think that this is maybe not an overriding big bill for a lot of planning opportunities for us, but it does clarify, is I think the big takeaway I would have on this. I also think that for certain people those would be some great opportunities, and maybe for our younger working family members who can take advantage of those tips or the overtime provisions.